everyone. I'm Tatiana Derugina, a professor of finance at the University of Illinois, and this is Econ Quick Takes. Sometimes you hear the claim, these tax cuts will pay for themselves. The idea behind this claim is that taxes suppress economic activity, which is in general true. So, if you cut taxes and economic activity increases by a lot, you can in principle have tax revenue go up. The tax rate is lower, but the amount being taxed is so much higher that the tax revenue, which is the product of the two, is higher too. Is this possible? Yes, in theory. We're going to take a look at something called the Laffer curve, named after Arthur Laffer, who first described it. Imagine the tax rate is 0%. Total tax revenue is of course 0. Now suppose the tax rate is 100%. Revenue will also be 0. No one will do something where everything they make gets taxed away by the government. So let's take a look at a graph that shows this. On the y-axis, we have the total tax revenue, and on the x-axis, we have the tax rate. So we have these two red points representing 0% revenue at 0% tax and 100% tax. Now, the tax rate is initially 0, then increasing it will of course also increase tax revenue. But because a 100% tax also has 0 revenue, there must be a tax rate beyond which tax revenue starts going back down as the tax rate increases. So we're going to have a curve that looks something like this. Initially, raising taxes increases revenue, but eventually we hit the peak of the Laffer curve, beyond which raising taxes will actually decrease tax revenue. Clearly, we never want to be on the downward sloping side of the Laffer curve in a typical market, because then you're just reducing economic activity and not even getting a higher tax revenue as a result. The clear solution in that case would be to lower the tax rate. Both economic activity and the tax revenue will increase. The next question is, are we actually on the wrong side of the Laffer curve? Here, things get more complicated because this is an empirical and not a theoretical question. But the short answer is there's no evidence that the US is anywhere near the wrong side of the curve. There's some evidence that Europe is near the peak of the Laffer curve, where tax revenue is maximized, but still on the side where cutting taxes decreases revenue. So, tax cuts will not pay for themselves. If the US or Europe lower the tax rate, tax revenue will decrease. This doesn't mean it's always a bad idea to cut taxes. Tax cuts will increase economic activity to some extent, just not enough to pay for themselves. But the government also needs tax revenue to pay for things that private markets are bad at providing, so some taxation is necessary. We'll discuss these considerations in another video. Until then, this has been Econ Quick Takes.